Internal Revenue Service IRS tax news. Expanded tax benefits help individuals and businesses give to charity during 2021. Deductions up to $600 available for cash donations by non-itemizers. IR 2021-190, September 17th, 2021, Washington. The Internal Revenue Service today explained how expanded tax benefits can help both individuals and businesses give to charity before the end of this year. The Taxpayer Certainty and Disaster Tax Relief Act of 2020, enacted last December, provides several provisions to help individuals and businesses give to charity. The new law generally extends through the end of 2021 for temporary tax changes originally enacted by the Coronavirus Aid, Relief, and Economic Security, otherwise known as the CARES Act. Here is a rundown of these changes. Deduction for individuals who don't itemize cash donations up to $600 qualify. So when we think about donations to charity, generally they're thought of and generally were the itemized deductions, meaning you would need to be able to itemize in order to take the deductions for charitable deductions, and that would mean that your itemized deductions would have to be greater than the standard deductions in order to benefit from them. Less people have that capability because they actually extended or expanded or increased the number or the amount of the standard deduction. So less people are actually itemizing. So now the question would be, well, how can we give a benefit to people to give to charity without making it an itemized deduction so everybody can basically benefit from it and not just those who are itemizing generally? And so they've got basically this component or a small piece of basically the itemized deductions that could benefit you even if you don't itemize, meaning you take the standard deduction, meaning generally your tax return is a more basic or simplified tax return because you're not itemizing. So ordinarily, individuals who elect to take the standard deduction cannot claim a deduction for their charitable contributions. The law now permits these individuals to claim a limited deduction on their 2021 federal income tax return for cash contributions made to certain qualifying charitable organizations. Nearly 9 in 10 taxpayers now take the standard deduction and could potentially qualify to claim a limited deduction for cash contributions. So let me just kind of give a recap on the general idea of the deductions here and a little bit of why these changes possibly were going into place. Not that I understand completely what the legislatures are thinking and so on, but notice that if you're talking about an income tax, normally what should be deductible, you would think with regards to an income tax, are those types of things that you had to do in order to generate the income. So if you look at the Schedule C, for example, for a sole proprietor, then those deductions make sense because those deductions that are expenses on your income statement for a Schedule C business in order to generate the revenue are things that you would expect to be normal kind of deductions in an income tax kind of system. In other words, if you made $100,000, they shouldn't tax you on the $100,000 if you had expenses that you had to incur of $50,000 in order to incur or earn the $100,000. Those would be kind of legit deductions, you would think. So that would be the general idea. Deductions would be things that you needed to expend in order to generate revenue. But then you got all these other kind of reasons as to why they put deductions in place, and they started to stack all those deductions in this itemized category. And I believe the process of that, the thinking of that was, well, we're going to try to give a standard deduction for everybody so that so everybody doesn't have to go through the pain of doing all this itemized deduction kind of things because it's going to take more work. And then if your income is above the threshold or your itemized deductions are above this threshold, then you take the itemized deductions. And they started to pack in things on the itemized deductions, which were a little bit unusual for an income tax for other purposes. So now you got things like the home mortgage interest is always debatable because, again, that's on a personal property. You finance the personal purchase. So you would think that there might have been some lobbying involved with home construction and that kind of stuff, and the idea of, trying to get everybody to get a home and whatnot, even though it's, there's a lot of different factors going on when you have a tax benefit like that. In any case, you've got the medical expenses, which are generally personal expenses, but you could see the idea being that we want to give some benefit for people that have medical expenses of up to a certain point and whatnot. And then they put in the charitable deductions, which again, you would think would be charity. The idea of charity shouldn't be like a tax benefit. You would think it's, it's its own thing or whatever, but they want to give a benefit on the tax code for it, even though it doesn't seem like a normal deduction. So they put that in there. They put state income taxes in there and then other state taxes as well, which again seems quite odd, real estate taxes and whatnot, because again, that kind of influences what the states are doing, which should be independent. So why would they be, influencing the federal side of things? So again, it all got kind of messy, and they put all those into the itemized deductions. And then in an attempt to simplify the tax code and kind of get away from the itemized deductions, which generally higher income individuals are generally the people that would benefit from the itemized deductions, they increased the standard deduction, which kind of lowered the amount of people that were doing these itemized deductions. And now, of course, now that the itemized deductions are not as relevant, it looks like they're going to try to take all those kind of things that they kind of liked in the itemized deductions and put them somewhere outside the itemized deductions, which again could be good or bad. But now you could see these deductions starting to pile up elsewhere on the tax return. So now we're increasing the charitable deductions here. The law now permits these individuals to claim a limited deduction on their 2021 federal income tax returns for cash contributions made to certain qualifying charitable organizations. Nearly 9 in 10 taxpayers now take the standard deduction and could potentially qualify to claim limited deductions for cash contributions. So these individuals, including married individuals filing separate returns, can claim a deduction of up to $300 for cash contributions made to qualifying charities during 2021. So you could basically take that deduction outside of the itemized area so you can get a benefit from them even if you're taking the standard deductions and are not itemizing. The maximum deduction is increased to $600 for married individuals filing joint returns. That kind of makes sense. I don't know why it was capped at $300 if married or single. In any case, $600 for married. For married sounds right. So cash contributions to most charitable organizations qualify. However, cash contributions made either to supporting organizations or to establish and maintain a donor-advised fund do not qualify. Cash contributions carried forward from prior years did not qualify, nor do cash contributions to most private foundations and most cash contributions to charitable remainder trusts. In general, a donor-advised fund is a fund or account maintained by a charity in which the donor, can, because of being a donor, advise the fund on how to distribute or invest amounts contributed by the donor and held in the fund. A supporting organization is a charity that carries out its exempt purposes by supporting other exempt organizations, usually other public charities. See publication 526, Charitable Contributions. There's a link to that here for more information on the types of organizations that qualify. Cash contributions include those made by check, credit card, or debit card, as well as amounts incurred by an individual or unreimbursed out-of-pocket expenses in connection with the individual's volunteer services to a qualifying charitable organization. Cash contributions don't include the value of volunteer services, securities, household items, or other property. 100% limit on eligible cash contributions made by itemizers in 2021. Subject to certain limits, individuals who itemize may generally claim a deduction for charitable contributions made to qualifying charitable organizations. These limits typically range from 20% to 60% of the adjusted gross income, AGI, and vary by the type of contributions and type of charitable organization. So now we're talking about the itemized areas, the normal areas, so you have a higher ability to put money in if you're itemizing. So if you're not taking the standard deduction and you're itemizing, then you're getting a benefit from the itemized deductions. The question is, how much can you then deduct when you are deducting charitable contributions on an itemized deductions? Those were adjusted recently as well. So, for example, a cash contribution made by an individual to a qualifying public charity is generally limited to 60% of the individual's adjusted gross income, or their AGI, basically an AGI or income limitation. Excess contributions may be carried forward for up to 5 tax years. So if you put more money in than you can due to the limitation on AGI, you still could have got a benefit, or still can generally get a benefit, but it will roll forward to the next year And then if you're not over the income limitation, you get the benefit in the following year, even though you made the contribution in the prior year. So the law now permits elected individuals to apply an increased individual limit, up to 100% of their AGI for qualified contributions made during calendar year 2021. Qualified contributions are contributions made in cash to qualifying charitable organizations. As with the new limited deduction for non-itemizers, cash contributions most charitable organizations qualify, but cash contributions made either to supporting organizations or to establish or maintain a donor-advised fund do not, nor do cash contributions to private foundations and most cash contributions to charitable remainder trusts. Unless an individual makes the election for any given qualified cash contribution, the usual percentage limits apply. Keep in mind that an individual's other allowed charitable contributions deductions reduce the maximum amount allowed under these elections. Eligible individuals must take their election with their 2021 Form 1040 or Form 1040-SR. Corporate limit increased to 25% of taxable income. So now we're on the corporate side of things. The law now permits C corporations to apply an increased corporate limit of 25% of taxable income for charitable contributions of cash they make to eligible charities during calendar year 2021. Normally, the maximum allowable contribution is 10% of the corporation's taxable income. Again, the increased corporate limit does not automatically apply. C corporations must elect the increased corporate limit on a contribution-by-contribution basis. Increased limits on amounts deductible by business for certain donated food inventory. Business donating food inventory that are eligible for the existing enhanced deduction for contributions for the care of ill, need, and infants may qualify for increased deduction limits for contributions made in 2021. The limit for these contributions deductions is increased from 15% to 25%. For C corporations, the 25% limit is based on their taxable income. For other businesses, including sole proprietorships, partnerships, and S corporations, the limit is based on their aggregate net income for the year from all trades or businesses from which the contributions are made. A special method for computing the enhanced deduction continues to apply, as do food quality standards and other requirements. Keep good records. The IRS reminds individuals and businesses that special record keeping rules apply to any taxpayer claiming a charitable contribution deduction. Usually this includes obtaining an acknowledgement letter from the charity before filing a return and retaining a canceled check or credit card receipt for contributions of cash. So make sure you got the documentation in the event that the IRS asks you for it. For donations of property, additional record-keeping rules apply and may include filing a Form 8283 and obtaining a qualified appraisal in some instances. For details on how to apply the percentage limits and a description of the record-keeping rules for substantiating gifts to charity, see Publication 526. There's a link to that. It's available on irs.gov. The IRS also encourages employers to help get the word out about advance payments of the child tax credit. There's a link to that here because they have direct access to many employees and individuals who receive this credit. For more information about other coronavirus-related relief, you can visit irs.gov/coronavirus. There's a link to that here. There'll be a link to this in the description.